recent years, the global financial landscape has been undergoing profound changes, signaling the end of the U.S. dollar's uncontested reign as the world's primary reserve currency. This transformation has been spurred by a series of strategic moves from central banks, influential private investors, and leading global institutions, suggesting that the financial system may be on the cusp of a significant shift. Central to this transition is the reclassification of gold as a Tier 1 reserve asset by the Bank of International Settlements, BIS, elevating it to the same status as U.S. dollars and U.S. treasuries. The U.S. dollar has served as the cornerstone of the international monetary system for decades, buoyed by its perceived stability and the global dominance of the dollar in trade. However, the BIS's decision to elevate gold signifies a potential turning point in the global financial system, as an increasing number of central banks and private investors appear to be repositioning themselves for a new era that may be anchored by tangible assets like gold. This pivot away from fiat currencies, which can be printed at will by governments, towards more stable and finite resources, may signal the beginning of a profound restructuring of the global financial system, with far-reaching implications for economies around the world. The foundation of the current global monetary order traces its roots back to the aftermath of World War II, when the international community sought to establish a stable framework to foster economic growth and provide support for post-war reconstruction. The Bretton Woods Conference of 1944 was the defining moment in the creation of this system. Representatives from 44 nations convened in Bretton Woods, New Hampshire, to discuss the future of the global economy. The conference led to the establishment of a new international monetary system, in which currencies were pegged to the U.S. dollar, which was in turn backed by gold at a fixed exchange rate of $35 per ounce. This system provided a stable anchor for the global financial system, as countries could exchange their U.S. dollars for gold and maintain confidence in the value of their reserves. Alongside this, the Bretton Woods Agreement led to the creation of key global financial institutions like the International Monetary Fund, IMF, and the World Bank, whose roles were to oversee international monetary policy and provide economic support to countries in need. The Bretton Woods framework set the stage for the rapid economic expansion in the decades following World War II, and the U.S. dollar, backed by gold, served as the world's reserve currency. However, by the late 1960s, the U.S. economy began to experience significant stress, and the stability of the Bretton Woods system started to come under scrutiny. The financial burden of the Vietnam War, coupled with expansive domestic spending programs like President Lyndon B. Johnson's Great Society, created substantial budget deficits, while inflation began to rise. The U.S. government responded to these economic challenges by increasing the money supply, which further strained the fixed exchange rate between the dollar and gold. As inflation surged and the U.S. dollar weakened, foreign countries, concerned about the devaluation of the dollar, began to demand gold in exchange for their dollar reserves. This led to a growing depletion of U.S. gold reserves, and by 1971, the situation had become untenable. In response to these pressures, President Richard Nixon announced that the U.S. would suspend the convertibility of the dollar into gold, effectively ending the Bretton Woods system and ushering in a new era of fiat currencies. Under this new system, currencies were no longer backed by physical assets like gold, but instead relied on the credit and trust of the governments issuing them. The decision to move away from the gold standard and adopt fiat currencies was transformative for the global economy. With no tangible asset backing the money supply, fiat currencies became subject to the influence of central banks and governments. The shift also meant that central banks could now print money without the constraint of having to hold gold or other assets in reserve. As a result, while this system allowed for greater flexibility in monetary policy, it also introduced new risks, particularly inflation and currency devaluation. Over time, these risks would become increasingly apparent, leading to a growing sense that a new financial order might be necessary. It is against this backdrop of uncertainty that the recent decision by the BIS to reclassify gold as a Tier 1 reserve asset should be understood. For decades, U.S. Treasuries have been considered the quintessential Tier 1 asset, representing a risk-free investment due to the perceived stability of the U.S. government and its ability to service its debt. However, in recent years, there has been a growing recognition that fiat currencies, particularly the U.S. dollar are not as stable as once thought. As central banks around the world have adopted increasingly aggressive monetary policies, such as low or even negative interest rates, the value of fiat currencies has come under pressure. At the same time, the central banks themselves have been accumulating unprecedented levels of debt, raising concerns about their long-term solvency. This environment has prompted some analysts to question the sustainability of the dollar-centric global monetary system. The BISE's decision to elevate gold to Tier 1 status suggests that the organization, which acts as a central bank for central banks, recognizes that the financial system may need to return to a more stable asset-backed framework. Gold, with its long history as a store of value and a hedge against inflation, offers an alternative to the volatility and risk inherent in fiat currencies. Unlike paper money, which can be printed at will, gold is a finite resource, and its value is largely immune to the whims of central banks. As a result, gold has become increasingly attractive to central banks, especially those in Europe and Asia, who have been repatriating their gold reserves and increasing their gold purchases in recent years. Countries like Germany, Austria, Hungary, and Poland have been at the forefront of this trend, bringing large portions of their gold holdings back from foreign storage, particularly from the U.S. Federal Reserve. The Bundesbank's decision to repatriate a significant portion of Germany's gold reserves from the U.S. marked the beginning of this coordinated effort, and other European nations quickly followed suit. This trend of repatriating gold suggests that central banks were acting on advanced knowledge of upcoming changes in the global reserve system. By increasing their gold holdings, these nations appear to be preparing for a future in which gold, rather than fiat currencies, could serve as the anchor of the global financial system. Adding to the momentum for systemic change, the IMF has recently called for a new Bretton Woods moment. This statement reflects a growing realization that the current monetary system, heavily reliant on the U.S. dollar, may no longer be sustainable in the face of rising global economic challenges. The IMF, which played a key role in overseeing the Bretton Woods framework, has expressed concerns that the world's reliance on fiat currencies and the U.S. dollar in particular has contributed to increasing volatility in the global economy. The introduction of a new monetary system could involve the return to a gold-backed framework, which would provide a more stable and reliable foundation for international trade and financial transactions. There is even speculation that such a system could involve the development of central bank digital currencies, CBDCs, that are linked to gold. A gold-backed CBDC would combine the intrinsic value of gold with the efficiency and transparency of digital currencies. Unlike traditional fiat currencies, which derive their value from the authority of the government issuing them, a gold-backed CBDC would be anchored to a tangible asset, providing a level of trust and stability that fiat currencies cannot match. CBDCs have the potential to revolutionize the way money is used and exchanged, offering greater efficiency, security, and transparency in financial transactions. For countries adopting such a system, it would also offer a more stable alternative to volatile fiat currencies. If such a system were to be adopted globally, it could significantly reduce the dominance of the U.S. dollar and create a more diversified and stable reserve asset structure. This shift could pave the way for a multipolar financial order where different currencies and assets play a more equal role in international trade and finance. In addition to these institutional changes, another key development in the global financial landscape is the emergence of a new category of traders on the Commitment of Traders (COT) reports published by the COMEX exchange. Traditionally, the COT reports have been dominated by two main groups: commercial traders, which include major banks, such as JP Morgan and Goldman Sachs, and speculative traders, such as hedge funds. However, starting in 2020, a third group referred to as the others began making significant moves in the market. This group, believed to consist of sovereign wealth funds and influential private investors, has been pulling large quantities of gold and silver off the exchange at an unprecedented rate. The scale of these withdrawals suggests that the others may have access to insider information or are acting on strategic insights into upcoming changes in the financial system. Their actions indicate a growing lack of confidence in the stability of fiat currencies and a strategic pivot toward tangible, more secure assets like gold and silver. This shift in market behavior underscores the growing recognition that a realignment of the global financial system may be on the horizon. China's Belt and Road Initiative, BRI, also plays a significant role in shaping the future of the global financial system. The BRI is an ambitious infrastructure project that seeks to connect Asia, Africa, Europe, and parts of South America through a vast network of railways, roads, ports, and digital infrastructure. The project encompasses over 70% of the world's population and nearly half of global GDP, and its scale is unmatched by any previous infrastructure initiative. By positioning itself at the heart of this trade network, China is challenging the dominance of the U.S.-led financial system and creating the conditions for a new economic order. The BRI's focus on green energy, digital infrastructure, and trade routes has driven significant demand for precious metals like silver, which is essential for electronics and renewable energy technologies. As China continues to integrate itself into the global economy through the BRI, it is effectively reshaping the global financial landscape and laying the groundwork for a more diversified and multipolar financial system. The shifting dynamics of the global economy are also evident in the declining demand for U.S. treasuries. In recent years, countries like China, Russia, and Japan, which have traditionally been among the largest buyers of U.S. debt, have been reducing their holdings of U.S. government bonds. This shift reflects concerns about the sustainability of U.S. fiscal policy, the increasing use of the dollar as a tool for economic sanctions, and the growing U.S. debt burden. As countries diversify their reserves away from U.S. treasuries, they have increasingly turned to gold as a safer alternative. The coordinated gold accumulation by central banks signals a move away from U.S. debt and towards more stable and tangible assets, potentially as part of a new global monetary framework. As the global financial system undergoes this transformation, the implications for the U.S. dollar and international trade are profound. The reclassification of gold as a Tier 1 asset, the rise of CBDCs, and the shift towards gold by central banks all suggest a world in which the dominance of the U.S. dollar is no longer guaranteed. Instead, a more diversified reserve asset structure may emerge, with gold, digital currencies, and other tangible assets playing a larger role. This shift could lead to greater financial stability, lower inflation, and a more resilient global economy. The role of gold, in particular, seems poised to be central in this new era of global finance, marking the end of the dollar's supremacy and the dawn of a more balanced and secure international financial system.